भैया इसके बाद एक कप और। नहीं नहीं मामा।
अरे ये क्या?
हॉर्लिक्स। नहीं, चॉकलेट।
चॉकलेट हॉर्लिक्स, चॉकलेट की खुशी, हॉर्लिक्स का पोषण। 5 दिन का पैक अब सिर्फ 20 रुपए में।
வெறும் ஜெர்சி போடுறதால யாரும் பும்ரா ஆயிட முடியாது. இந்த காயினை பறக்க விடு, நீ தான் அடுத்த பும்ரா. Come on. Never gonna stop. Boost in புதிய சின்ன பேக் ₹5 மட்டுமே.
Boost is the secret of our energy.
নলেন গুড়ে সেই মিষ্টত্ব, তাতে এলো আরো বিশেষত্ব। কোয়ালিটি ওয়ালস নলেন গুড়।
एवढे लांब केस आणि इवलीशी तू दुसरा दे।
दूसरा कशाला?
लांब केसांना एक नाही 2 हवे, हो की नाही?
म्हणूनच लांब केसांसाठी क्लिनिक प्लसचा लांब पॅक। ह्यात मिळतात 2 वॉश। पहिला खोलवर साफ करतो तर दुसरा मुळापासून पोषण देऊन मुलीच्या केसांना स्ट्रॉंग बनवतो। क्लिनिक प्लस। मेरी स्किन लगे हमेशा फ्लॉलेस, इसलिए मैं रहती हूँ रेडी फॉर अ क्लोज-अप। न्यू लैक्मे स्किन ड्यू सीरम फाउंडेशन, हमारा फर्स्ट फाउंडेशन जिसमें है सीरम के बेनिफिट्स। फ्लॉलेस फिनिश ऑन द आउटसाइड, सीरम का केयर ऑन द इनसाइड। स्किन केयर नाउ इन अ फाउंडेशन, 24 आवर्स तक ड्यूई स्किन। लैक्मे स्किन ड्यू सीरम फाउंडेशन। न्यू ग्लो एंड लवली हाइड्रो ग्लो। सुबह सुबह चेहरे का ग्लो पूरा ऑन, पर ग्लो शाम तक टिकेगा? हो गया ना चेहरा डल और मुरझाया? क्योंकि दिन में चेहरे की नमी 30% कम होती है, तो ग्लो भी कम। इसीलिए न्यू ग्लो एंड लवली हाइड्रो ग्लो। इसमें है रोज सीरम जो दे अंदर तक नमी और मिले खिला खिला ग्लो। नमी मिले, ग्लो खिले। न्यू ग्लो एंड लवली हाइड्रो ग्लो।
When it comes to multitasking, you're always on top. But somewhere between stuffed schedules and long commutes, me time slipped to the bottom of your to-dos. So what's really keeping you from taking care of you? Is it the time, effort, and a little guilt too? Just a few moments each day with yourself is all it takes to go back to your happy place. Your happy place is where your memories, dreams, and hopes reside. You know them through their colors, smells, the way they make you feel. Each of our collections is an invitation to return each day, if only for a moment or two, to this space, to this feeling, to you. Find your happy place. Bath and Body Rituals, now in India.
भैया इसके बाद एक कप और। नहीं नहीं मामा।
अरे ये क्या?
हॉर्लिक्स। नहीं, चॉकलेट।
चॉकलेट हॉर्लिक्स, चॉकलेट की खुशी, हॉर्लिक्स का पोषण। 5 दिन का पैक अब सिर्फ 20 रुपए में।
வெறும் ஜெர்சி போடுறதால யாரும் பும்ரா ஆயிட முடியாது. இந்த காயினை பறக்க விடு, நீ தான் அடுத்த பும்ரா. Come on. Never gonna stop. Boost in புதிய சின்ன பேக் ₹5 மட்டுமே.
Boost is the secret of our energy.
নলেন গুড়ে সেই মিষ্টত্ব, তাতে এলো আরো বিশেষত্ব। কোয়ালিটি ওয়ালস নলেন গুড়।
एवढे लांब केस आणि इवलीशी तू दुसरा दे।
दूसरा कशाला?
लांब केसांना एक नाही 2 हवे, हो की नाही?
म्हणूनच लांब केसांसाठी क्लिनिक प्लसचा लांब पॅक। ह्यात मिळतात 2 वॉश। पहिला खोलवर साफ करतो तर दुसरा मुळापासून पोषण देऊन मुलीच्या केसांना स्ट्रॉंग बनवतो। क्लिनिक प्लस। मेरी स्किन लगे हमेशा फ्लॉलेस, इसलिए मैं रहती हूँ रेडी फॉर अ क्लोज-अप। न्यू लैक्मे स्किन ड्यू सीरम फाउंडेशन, हमारा फर्स्ट फाउंडेशन जिसमें है सीरम के बेनिफिट्स। फ्लॉलेस फिनिश ऑन द आउटसाइड, सीरम का केयर ऑन द इनसाइड। स्किन केयर नाउ इन अ फाउंडेशन, 24 आवर्स तक ड्यूई स्किन। लैक्मे स्किन ड्यू सीरम फाउंडेशन। न्यू ग्लो एंड लवली हाइड्रो ग्लो। सुबह सुबह चेहरे का ग्लो पूरा ऑन, पर ग्लो शाम तक टिकेगा? हो गया ना चेहरा डल और मुरझाया? क्योंकि दिन में चेहरे की नमी 30% कम होती है, तो ग्लो भी कम।
इसीलिए न्यू ग्लो एंड लवली हाइड्रा ग्लो, इसमें है रोज सीरम जो दे अंदर तक नमी और मिले खिला खिला ग्लो।
नमी मिले, ग्लो खिले।
न्यू ग्लो एंड लवली हाइड्रा ग्लो।
Ladies and gentlemen, good day and welcome to Hindustan Unilever Limited conference call for the results for September quarter 2022. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. A. Ravi Shankar, Group Controller and Head of Investor Relations. Thank you, and over to you, sir.
Thank you, Tanvi. Good evening, everyone, and welcome to the conference call of Hindustan Unilever Limited. We'll be covering this evening the results for the quarter ended 30th September 2022. On the call with me is Sanjeev Mehta, our CEO and Managing Director, and Ritesh Tiwari, our CFO. We will start the presentation with Sanjeev sharing an overview of our performance in this quarter and the operating environment. Then Ritesh will cover our financial results in more detail and share our future outlook. Before we get started with the presentation, I would like to draw your attention to the safe harbor statement included in the presentation for good order's sake. With that, over to you, Sanjeev.
Thank you. Good evening, everyone, and delighted to have you join us for the call. My best wishes to you, your loved ones, everyone in your business, and wish all of you a very happy Diwali. Now, let me first start with a quick summary of our performance for the quarter and then cover the external environment and our strategy. Then, of course, we'll have Ritesh, our CFO, take you through the results and the outlook in detail. Now, from our lens, it was very clearly another quarter of strong all-round performance. Our top line grew at a solid 16% with an underlying volume growth of 4%. We continue to significantly outperform the market with more than 75% of our business winning value and volume market shares. EBITDA margins at 23.3% remain healthy despite the unprecedented inflation that the industry is witnessing. Our EPS grew 20%, including the benefit that we got from one-off prior period tax credits. Profit after tax, but before exceptional items, grew 9%. Now, our consistent strong performance is reflective. Again, we talk about it, strategic clarity, strength of our brands, our immense capabilities, our talented people, and our agility to run the business. I'm very pleased to report that we have added more than 4,000 crores to our top line in the first half of the fiscal and had a turnover in excess of 28,500 crores. Ritesh will, of course, cover the first half performance in much more detail. Now, let me spend some time on the external environment, the inflationary situation, and the FMCG market growth. While there has been some easing of commodity prices and supply chain pressures, inflation still continues to be a significant challenge for the industry. Except palm oil, which has seen a meaningful correction from its peak, most commodities remain volatile and elevated. In fact, some commodities such as soda ash, milk powder, barley, and cereals have further inflated during this quarter. The other source of inflation has been the currency. Globally, high levels of inflation have triggered aggressive monetary tightening measures from central banks globally across the world. This has led to a strengthening of US dollars. Now, US dollar INR rate, which was around 74 at the beginning of this fiscal, has crossed the 80% mark, hovering around 82 halfway through the year. CPI inflation continues to be above RPI threshold since January of this year, driven, of course, by higher fuel and energy prices and the food inflation. Within this, rural inflation was higher than urban. Let me now talk about FMCG market growth with reference to the categories we operate in. In September quarter, markets grew in mid-single digit. If you compare this versus last 12 months, value growth has improved marginally, driven by higher pricing. Volume continued to decline in both urban and rural markets, with a more pronounced drop in rural. Of course, if we look at the last 3 months numbers, on a 3-year CAGR basis, both urban and rural markets have grown in mid-single digit with a marginal decline in volume. It is quite natural for consumers, especially at lower income levels, to feel the pinch of increased pressure on their wallets due to the high inflation, and they do adjust volumes and prioritize essentials over discretionary to manage their household budgets. Hence, to summarize the last 2 slides, the FMCG market context hasn't changed significantly in this quarter and continues to remain challenging. Now, we have a very clear and compelling strategy, and that remains unchanged. The 2 imperatives are: we will continue to navigate the short-term challenges with agility and grow our consumer franchise whilst protecting our business model. For instance, when it comes to pricing, with the meaningful correction that we have seen in palm oil prices, we are now taking price cuts in big chunks in our skin cleansing portfolio to pass on the benefits to consumers and maintain the right price-value equation. While on the other hand, in home care, we have taken further pricing in September quarter as we saw more inflation in key input materials. The second imperative is that we need to continue single-mindedly on a journey to create a purpose-led future-fit HUL and deliver a 4G growth agenda. Growth, as all of you are aware, we talk about in terms of consistent, competitive, profitable, and responsible. I'm sure you're familiar with the 5 strategic choices. In my next couple of charts, I'm going to elaborate a bit more on developing a portfolio and a progress in the sustainability journey. First, let me bring to life how we are developing a portfolio leveraging the capabilities that we are building under Reimagine HUL. A premium beauty business unit, which is an incubator for digital brands and capabilities, has launched 2 new digital brands, Acne Squad and Find Your Happy Place. Acne Squad is a specialist brand co-created with dermatologists and backed by patented technology that addresses unmet needs of the hyper-connected consumer. It includes a range of 11 skincare products and curated regime kits proven to offer best-in-class acne treatment at each stage of acne life cycle. Find Your Happy Place has 4 mood-transforming experiential bath and body ranges that includes moisturizing shower gel, bath scrub, bath salts, candles, body lotions, and body butter. These are again crafted for hyper-connected digital consumers in an era where the trend and need for self-care is at an all-time high. Each of the 4 launched fragrance families has been specially designed to appeal to Indian sensibilities, all of them rekindling a memory of one's favorite place, person, or feeling. These are completely digital brands launched through our Agile Innovation platform, right from trend spotting through digital and social media listening to use of digital technology to curate mixes in an agile manner. For instance, through our studies, we realized that acne is one of the most common searches on skincare and amongst the top concerns faced by our consumers, hyper-connected consumers. Yet, there are very few specialist brands that address this concern. Very quickly, we were able to curate the right mixes, providing targeted solutions for every stage of the acne life cycle. This agile innovation approach has enabled us to launch new products in half the time it used to take earlier. Our 3 nano factories give us the flexibility to manufacture closer to demand and in small batch sizes. We now have 14 bespoke D2C platforms to give unique shopping experience to the consumers. We're extensively using digital marketing and influencer campaigns to reach out to hyper-connected consumers. Digital media contributes to more than 25% of our total media spend. We are leveraging latest digital tools and technologies to create end-to-end digital journeys for our consumers. Now, let me talk about responsible growth. We are a company of brands and people with a clear purpose to make sustainable living commonplace. We believe in doing well by doing good. Dove's purpose is to make beauty a source of confidence and not anxiety. As part of its self-esteem project, Dove is helping young people build positive body confidence and self-esteem. Last year, Dove began a movement, Stop the Beauty Test, to raise voice against beauty biases girls have to face while finding a life partner. In the second leg of this campaign, Dove is breaking stereotypes and urging the society to place emphasis on education instead of seeing girls from the eyes of prospective groom. Project Shakti, we had launched this in the early part of this millennium with the aim to financially empower and provide livelihood opportunities to women in rural India. Today, we have more than 160,000 Shakti entrepreneurs. We are now digitizing the Shakti Amar through our flagship Shikhar app to bring them to the forefront of the new digital India. Till date, we have onboarded over 50,000 Shakti women on the app who are now able to place orders at their convenience and get HUL products in an easy and reliable way. Our Dapada home care manufacturing site has added a new feather in the cap. The site has been recognized by World Economic Forum as a sustainability lighthouse. First company in India across sectors to achieve this status. The sustainability lighthouse status reflects the use of revolutionary technologies, including digitally enabled manufacturing processes that have amplified speed and agility and has lessened environment impact by reducing energy, water, and material waste. This recognition comes on the back of the unit being accorded the designation of an advanced fourth industrial revolution lighthouse earlier this year. A fitting example of making HUL purpose-led and future fit. With this, let me now hand over to Ritesh, our CFO, to talk about our performance in this quarter and our outlook in much more detail. Ritesh, over to you.
Thank you, Sanjeev, and good evening, everyone.
Sir, so should we begin with questions?
Hello. Hi.
Yes.
I'll continue now.
Sure.
Thank you, Sanjeev, and good evening, everyone. My greetings to you and your family for the lovely festive season ahead. I will now walk you through our in-quarter performance and our outlook. We continue to build on our strong growth momentum with top line growing 16% in the quarter. Despite the high levels of inflation and declining market volumes, we have delivered a robust underlying volume growth of 4%. Our performance has been significantly ahead of the market, and more than 75% of our business is winning value and volume market shares. Moving to bottom line, net profit at rupees 2,616 crore grew 20%. Profit after tax before exceptional item grew 9%. There were one-off prior period tax credits in this quarter, and that largely explains the difference in the growth of net profit and profit after tax before exceptional items. Our EBITDA margin was at a healthy 23.3% despite the unprecedented inflation. Let me spend a couple of more minutes talking about how we're navigating this challenging environment through dynamic financial management. As we had anticipated and called out earlier, almost all commodities, sans palm oil, continue to remain at significantly elevated levels. This, along with consumption of higher cost inventory, has led to a 590 BPS year-on-year increase in our cost of goods sold in this quarter. This also includes an impact of 70 BPS coming from higher investment in consumer promotions. Despite this, we have been able to hold EBITDA margins at a healthy 23.3%, which translates to 180 BPS year-on-year decline and 10 BPS sequential improvement. This was possible due to our clear focus on fundamentals that we have been consistently speaking about. And these are, to start with, operating our business with agility and ensuring that we provide the right price-value equation to our consumers. Adequately supporting our brands with marketing investments, while sharply attributing media spends to growth and maintaining our share of voice ahead of our market shares. Number 3, investing in our products and giving better value to the consumers. As we had called out, our product superiority continues to be 2 times the pre-COVID levels. And importantly, number 4, we continue to drive savings harder and optimize all non-consumer facing costs. Through this frugal mindset and growth leverage, we have delivered a net 160 BPS reduction between other expenses and employee costs, where employee costs increased by 20 BPS on account of salary inflation and variable pay true-up for the first half performance. Moving on to performance across our 3 segments. Home care delivered another stellar performance, growing at 34% with double-digit volume growth. Beauty and personal care grew ahead of the market at 11%. Foods and refreshment had a steady quarter, growing at 4%, led by strong performance in foods, coffee, and ice cream. Despite the significant inflation, our margins in all 3 segments remained at healthy levels, with home care at 17%, BPC at 25%, and FNR at 20%. We will click down to talk about performance within each of the divisions in subsequent slides. Talking about innovations, this has been a busy quarter for our marketing teams as we have launched several products across many of our brands. This is in addition to the 2 new digital brands, Acne Squad and Find Your Happy Place, that Sanjeev talked about. Let me pick up a few to elaborate. Our digital brands, Simple and Love Beauty and Planet, have expanded their portfolio further. Simple has launched a new vitamin C range for complete skincare regime. Love Beauty and Planet has launched new hair care products. Our iconic beauty brand Lakme launched a new foundation which is infused with goodness of serum that works both as a makeup and skincare. Glow & Lovely launched Hydra Glow, a cream enriched with rose serum. Extending our Horlicks franchise, we have seeded a new format, gummies, and launched 2 products, Nutri Gummies and Diabetes Gummies, on our digital platforms. Nutri Gummies are specially crafted to fulfill nutritional gaps and is enriched with 12 vitamins and minerals. Diabetes Gummies is powered with mulberry leaf extract, which helps to manage the risk of diabetes in a convenient way. Quality Walls added exciting new flavors such as Nolan Gur, Gulab Jamun, and Milk Cake to add more joy to the festive season. Surf Excel Matic introduced Power Concentrate, a revolutionary concentrated liquid formulated to give 2 times cleaning power with an intense, long-lasting fragrance. Expanding the peanut butter range, Kisan has launched new hazelnut choco peanut spread. Talking about our new marketing campaign, Boost has activated a new film which aims to break stereotypes around girls and sports. Glow & Lovely has a new communication for its Ayurvedic face cream. Hamam was relaunched in this quarter with a new superior product. The relaunch was followed with a campaign around building courage with girls to embrace the outside world. Moving on to our performance in home care, our business delivered yet another stellar quarter at 34%, with robust performance both in fabric wash and household care. Despite high pricing, home care grew volumes in double digits, reflecting the strength of our brand and portfolio. Fabric wash delivered high double-digit growth and handsome market share gains, led by robust performance across the portfolio. Supported by our strong market development actions, liquid detergents and fabric conditioners continue to outperform and is now more than 2,000 crore annual business. Household care grew in high double digits, driven by solid performance in dishwash. Our dishwash brand Vim won the Cantor Creative Effectiveness Award for its Unstereotype campaign. With more input cost inflation, we have taken calibrated pricing actions both in fabric wash and household care. Next, talking about beauty and personal care, the business grew 11%, driven by outperformance in premium portfolio. Skin cleansing delivered broad-based, strong double-digit growth. Beauty and premium brands with Lux, Dove, and Pears continue to outperform and delivered mid-single-digit volume growth. Lifebuoy soap grew in high teens and continues to be the market leader in this segment. We are now passing on the benefit of lower commodity costs to consumers and taking price cuts in big chunks. Hair care further strengthened its market leadership with strong broad-based performance. Our innovations and future formats such as masks and serums continue to gain consumer relevance. As in previous quarters, skincare and color cosmetics performance has been a story of two halves. Premium parts of the portfolio, such as Lakme and Pond's, outperformed, delivering double-digit growth. However, inflation impact on discretionary consumption affected the performance of our mass segment, such as Glow & Lovely and Talc. Oral care had a steady quarter led by Close-Up. Let me now turn to foods and refreshment. F&R grew 4%, led by strong performance in foods, coffee, and ice cream. Tea continued to cement its market leadership and grew volumes in mid-single digit. In-quarter performance was muted as price cuts impacted overall value growth. Coffee sustained its strong growth momentum and grew in double digits. In health food drinks, we continued with our market development actions to build category relevance. In this quarter alone, we have reached almost 9 million consumers through our Home-to-Home Connect program and launched new TV campaigns. Horlicks Mother Plus partnered with Farm Easy to build nutrition awareness and drive trials with new mothers. We also seeded new formats and launched Nutri Gummies and Diabetes on our digital platforms, as I mentioned earlier. All these actions have helped us continue gaining market shares and penetration. Overall category growths have remained subdued due to impact of inflation on discretionary consumption. Foods delivered strong double-digit growth with volumes growing in mid-teens. This was led by jams and foods solution business. As we had called out earlier, the reopening of schools has increased the consumption occasion for jams. Our food solution business that provides products for chefs and restaurants continue to scale up and is now almost double of pre-COVID levels. Ice cream had another strong quarter with double-digit growth on a very high base. Our innovations such as Feast Black Forest, Trixie Cheesecake continue to perform well. Ahead of the festive season, we added more exciting flavors that I mentioned earlier. Now let me summarize. Our performance has been strong in the quarter with 16% sales growth and 20% growth in net profit. As I mentioned earlier, we had a one-off tax prior period adjustment in this quarter, and including that, our ETR for this fiscal year is expected to be around 24%. Let me quickly take you through the results for the first half of this fiscal. We delivered a strong performance both on top line and bottom line. We have added more than 4,000 crores to our top line, growing at 18% and taking our turnover to rupees 28,530 crores. Despite unprecedented levels of inflation, we have maintained EBITDA margins at a healthy 23.2%. Net profit at 4,905 crores grew 15%. Profit after tax and before exceptional items grew 13%. Taking into account the strong performance of the company, I'm pleased to inform you that the board of directors have declared an interim dividend of rupees 17 per share for the year ended March 31st, 2023, which is a step up of rupees 2 as compared to the interim dividend of last fiscal. Now moving on to our outlook. Let me start with giving you some more color how inflation is panning out. Our September quarter's net material inflation is at 22%, and this is sequentially higher than June quarter. This is in line what we had called out earlier during June quarter results. Consequently, our COGS has increased sequentially by 150 BPS to 55% in this quarter. You will recall from our earlier slide that Sanjeev covered, most commodities are still at significantly inflated levels and are holding firm. Strengthening of US dollar is also adding to further inflation. However, few commodities, largely palm oil, have corrected from their highs. With this softening, and if other commodities remain at the current elevated levels, we expect our December quarter NMI to be slightly lower than our September quarter numbers, albeit remaining significantly high on a year-on-year basis. This will help us to marginally reduce the price versus cost gap and aid in sequential gross margin improvement. With the likely increase in media intensity, we will dial up our brand and marketing investment and continue to ensure our share of voice remains ahead of our share of market. Needless to say, we will continue to extensively drive productivity improvement and operate our business with agility to maintain right price value equation for our consumers. Looking ahead, we are cautiously optimistic. In the near term, demand environment remains challenging and growth will be price-led. If commodities were to remain where they are today, we expect the price versus cost gap to marginally narrow, leading to a sequential improvement in gross margin in December quarter. With the likely increase in media intensity, we expect a step up in our A&P investments. Our two clear imperatives remain. First, our priority is to grow our consumer franchise and protect our business model. We will do this by investing competitively behind our brands, ensuring the right price-value equation for consumers, and driving savings harder. And second, continue with our journey to create a purpose-led, future-fit HUL and deliver 4G growth that is consistent, competitive, profitable, and responsible. Before we move to Q&A, let me summarize what we covered till now. We continue to build on our strong growth momentum and deliver 16% top-line growth with 4% underlying volume growth. In the first half of this fiscal, we've added more than 4,000 crore to our top line, growing at 18%. Our growth was significantly ahead of the market, with more than 75% of our business winning both value and volume shares. Despite the unprecedented level of inflation, our EBITDA margins remain healthy. Considering the strong performance, Board of Directors have declared an interim dividend of rupees 17 per share. We are cautiously optimistic about the near-term demand environment, with growth being price-led. We expect our December quarter NMI to be marginally lower than September quarter, albeit remaining significantly high on a year-on-year basis. Consequently, gross margin in DQ is expected to improve sequentially, along with a step up in A&P investments. With this, let me hand over to Ravi to commence our Q&A session.
Thank you, Sanjeev. Thank you, Ritesh. With this, we will now move on to the Q&A. As usual, we would request you to restrict your questions to a maximum of 2 at a time. In case there are further questions, you are always welcome to join the queue again. In addition to the audio, our participants have an option to post the questions through the web option on your screen. We'll take these questions just before we end. With that, I'd like to hand the call back to Tanvi to manage the next session for us.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks. My first question is in categories where deflation has started, is HUL playing a different template? Why I'm asking this is in tea, there is around 7 to 8% price correction at the consumer level. Against that, your 5% volume growth looks impressive, given the other large player has reported negative volume. And Nielsen overall FMCG is negative volume in both urban and rural. So unlike earlier times when deflation happened, regional players used to come back. This time it seems you have gained market share in tea from regional and clearly the other large players. So could you help us understand that? And similar template, can it be followed in skin cleansing also, because there also deflation has started?
Before I hand it over to Ritesh, Abneesh, we launched Nolan Good ice cream for you. I hope you have tasted it.
Yes, sir. It was very good. I like that.
Wonderful.
Abneesh, thanks for your question. And there are pockets, and exactly called out, tea and skin cleansing are the two categories which have seen commodity costs coming off. It was tea commodity earlier and then vegetable oil later on. Outside these two categories in commodities, there is significant year-on-year inflation across the board, which impacts all other categories. On tea, our strategy has been consistent. It's a portfolio play. It's a play where winning in many India strategy, we have brought alive excellently well with our products, with our innovation, and the way we manage our formulation pricing across the country. And with our portfolio in tea, focus has always been, as I mentioned, that whenever inflation has come and impacted us, our strategy is very clear: grow the consumer franchise and protect our business model. And that's exactly what we have done with tea category as well. we have we cemented our market leadership, as we called out. We have grown volumes, and we have also passed on the benefit of price reduction through price cuts to the consumers. And our pricing strategy, Abneesh, is very similar to what we had spoken earlier, that when market inflation happens, we take price increases in small bites so that we're able to land those prices effectively and ensure that we're able to hold and keep growing consumer franchise. But conversely, whenever market commodities come off to some extent in select places, we take larger bite decreases. And one has to do that, otherwise inventories in the trade will get caught in between price points. That's exactly what we have done in tea, and to your point, very similar we have recently done in skin cleansing as well, where there's a meaningful correction in palm oil prices. Of course, in last week or 10 days time, you've seen a further 15-20% increase in palm oil prices have happened. But our strategy will exactly remain consistent, which is keep growing the consumer franchise and protect the business model. While doing that, our entire focus, Abneesh, on driving savings hard across lines of P&L and challenging every non-consumer facing cost, that continues. And we are running our business with agility. And in the meantime, we will move prices up and down as required to ensure competitiveness and to ensure that the price value equation remains and gets maintained with the consumers. So that strategy will continue depending upon which way commodity pans out for different categories that we deal in.
Sure. That's helpful. My second and last question is on foods. So Nestle also reported very strong growth, and they pointed out quick commerce really helping them. In your case, ice cream saw a great first quarter because of harsh summer. Q2 also has been very good. So if you could elaborate how much help you are getting from quick commerce, any numbers you can put in any of your food categories, especially ice cream. And second one on foods is how much is the addressable market in terms of Nutri gummies and diabetes gummies? Now, further milk inflation has happened. So quarter on quarter, more in milk inflation has happened. So on the core part of Horlicks, are things getting even more tougher because milk prices clearly matter in that consumption?
Yeah. So 3-4 different questions. Let me pick them one by one, Abneesh. First, you talk about foods growth. Our within foods and refreshment as a division, our foods business has grown double digit. And as I alluded earlier, ice cream, food within that, coffee, these are the businesses within foods and refreshment have seen good double digit growth across the business. And we have absolutely taken benefit of quick commerce. So today, ice cream now, as we call it, our ice cream business where it gets distributed through quick commerce and such digital chains. Now it's more than 10% of our ice cream business is today generated using this medium of distribution. Talking about Horlicks and Nutri gummies, we have expanded our format of what we sell in Horlicks, and you've seen our launch of 2 gummies. One is with 12 different vitamins and minerals, Nutri gummies, and second is to manage diabetes better, diabetes gummies. These formats now we have launched online on our D2C platform, and as relevant, we have already extended one of the 2 into online pure play as well as we speak. And we with this point in time, these are seeded in the market, and of course we learn more this format and this product, how consumer reaction we get from these products. So that's a Nutri gummy. Now, as far as core Horlicks is concerned, no change in strategy. Exactly what we had mentioned to you and to all of you that market development is the job to be done in this area. Having done full job of integration of Horlicks, which has happened very well, realizing savings of supply chain integration and other overhead integration fully realized, our focus is now to continue to build penetration and consumption in the category. This quarter alone, we have done more than 9 million home-to-home connects. We launched new advertisement campaign to bring alive our portfolio. So that effort across the portfolio is also started to yield result. For example, our penetration is building. We are gaining penetration. We are also seeing our market share improving. And this I had mentioned earlier that this is a job which will be job that will be done in medium term. We will be at it in terms of developing this category and segment, and we should start seeing traction with this continued effort of staying consistent with our market development strategy with Horlicks.
Sure, thanks. That's all from my side. Thank you.
Thank you. Thank you. The next question is from the line of Vivek M. from Jefferies. Please go ahead. Vivek, your line has been unmuted. Please unmute yourself and proceed with your question. As there is no response, we'll move to the next question, which is from the line of Avi Mehta from Macquarie. Please go ahead.
Thanks a lot for this opportunity. Just on the commodity inflation, you highlighted that commodity inflation has been broadly along the expectation, even though this increase is happening this quarter. In that backdrop, would you retain your comment that you made in first quarter that 3Q should see the benefit of commodity moderation in palm oil versus the margins that we saw in first quarter?
Yeah, so thanks, Avi, for the question. And absolutely right. When last quarter we had announced June quarter results, and our net material inflation was 20%. And I had alluded at that point in time that we expect to see sequentially more inflation in the next quarter. And that's exactly what we have now also shared with you, that our inflation this quarter is 22% net material inflation. So it is panned out the way we had anticipated. Our outlook for the quarter after, the second half outlook, and starting with December quarter, we should see slight reduction in net material inflation for December quarter. And a large component of that reduction basically is vegetable oil. And that should lead to slight reduction. And the reason I'm using the word slight reduction, because everything else outside vegetable oil remains elevated. Crude oil, it is still firm at 90 plus. And with currency depreciation of US dollar centering rupee at 83, that impact almost makes crude equivalent to $100 plus, what we had some time back. So milk, number one, cereals, soda ash, across the board, many commodities, it remain elevated on year-on-year basis. So we have significant inflation outside as well. Now with this some amount of cooling off of vegetable oil, we should see, as I mentioned, slight improvement in the net material inflation, and hence we should see sequential gross margin improvement that we should see in next quarter. As that happens, I'm also very mindful that media intensity might increase as there is some cool off in certain pockets of commodities that will happen. And with media intensity increasing, we will continue to do what we have done, which is maintain our share of voice ahead of the share of market. So I also expect advertising and sales promotion intensity to go up, and hence our investment in A&P to go up next quarter. And EBITDA will be ultimately outcome of amount of impact we'll end up seeing on commodity, and hence NMI, and hence gross margin, and the amount of media intensity, which will calibrate our A&P investments. And that will ultimately determine the outcome of EBITDA. But those are the few variables which will be at play looking ahead for second half of this financial year.
Sorry, Ritesh, let me rephrase. What I meant is why I kind of take your point that you have seen some inputs see in inflation in the second quarter. But, when you were kind of going into that slide, you mentioned that this increase was broadly in line with what we were expecting. So from an inflation perspective, it seemed that nothing has surprised you on the negative, as in, inflation has not come ahead of what you were expecting. That is the backdrop, and hence I was kind of looking at from the lens that I was in, or when we were looking in the first quarter, whatever margins we were expecting in the second half is the margin that we will still expect to be in the second half. Is that understanding correct, is what I was trying to allude to. That is what I wanted to kind of appreciate. Is it fair that is what is the case?
Yeah, so our read of A, commodity, B, FMCG has not changed in last 3 months' time. It is very consistent to what we spoke last quarter. Be it the outlook of commodity we had mentioned, and as you reiterated, of seeing a peak in September quarter and some cool off after that. And we had mentioned that it is largely led out of vegetable oil. It is indeed the case. Our read on FMCG market overall, the impact of consumption, impact of rural, and hence volumes, again remains very consistent. So yes, at this point in time, you're right. There is no different read that we have in second half of the year and margins for second half of the financial year. It's a very similar read, a consistent read, and which is what I give a little more granular data points to you that we will see, as we spoke earlier, sequential gross margin improvement, and media intensity, of course, is what we will see as to what pans out. But yeah, very similar read.
Got it, Ritesh. Got it. So it gives me a sense on the sequential increase as well, because one case the comparison. Fair point. The second question was on the rural recovery. Just wanted to get your sense on how do you feel about rural right now? Are you feeling more constructive? versus what you felt last quarter, or any comments on that? That's all from my side. Thank you.
Yeah. So the rural, as we had called out, and let me just use some data points out here. And if I look at a 3-year CAGR, rural urban both for FMCG market is growing at mid-single digit. And again, on 3-year CAGR, urban rural both are flat, near flat on volume. If I look at near-term period, latest 12-week or a MAT basis, urban is clearly outpacing rural, where urban growths are stronger than rural, and also volume decline in rural is more steeper compared to urban. So the read that we had, that inflation is biting in rural more compared to urban, that is indeed the outcome that we are seeing. And that inflation impact is seen in volume decline in market in rural, and hence overall value growth of rural continues to be muted. So that pins out. Of course, as far as Hindustan Unilever is concerned, we have gained comprehensively market share both in urban and in rural, but overall, of course, growth will be determined by what happens in terms of the market. Now, coming to outlook, I do believe there are the single biggest factor which will determine rural outcome as far as FMCG is concerned is the impact of commodity. If at all we see a broader basket of commodities cooling off the way vegetable oil has, that should help price to come down. And if that helps the price to come down, that will augur well as far as consumption is concerned, volume, and hence FMCG growth. This is when I look at FMCG. Of course, there are macro factors at play. The good news is urban employment is increasing, which would mean that rural migration and non-farm income, and hence giving money back to the rural area, and hence having more money in the pockets in rural economy, that augurs well. Monsoon has been normal, and the reason I say that, it was good rains, but we all know the spatial coverage and the volatility in that space, and also the timing of monsoon in certain place basically has a mixed outcome. We have yet to see how that pans out in terms of the crop going forward. So that's one element which is there in the mix. Government is clearly leaning in. The news that we had earlier, fertilizer subsidy, the fuel duty cuts, that is helping. The recent decision of government also to extend the food grain subsidy till end of the year will also augur well. So there are definitely macro factors, and including what we all know, the 7.5 lakh crore capex investment which government has committed as part of this budget. All of that should augur well for the rural economy. But we have to see more data points to feel comfortable. When I look at this latest quarter, the data points for the September quarter are not very different than the read that we had for last few quarters. So the read remains consistent, and there are macro factors which are helping, and we do hope that in times to come, we see outcome which is better compared to what we're seeing today.
Got it. Thanks a lot for this, and wish you all a very happy Diwali and a prosperous New Year. Thank you very much.
Thanks, Ravi. Happy Diwali to you as well.
Thank you. The next question is from the line of Harit Kapoor from Investec India. Please go ahead. Harit, your line has been unmuted. Please proceed with your question.
Yes, sir, we can move.
Harit, if you can just repeat your question now.
Yeah, am I audible?
Yes, now.
Yes.
Yeah, good evening all. I just had two questions. Firstly, just wanted to get your sense on, the A&P spend number. At about 7% it's at a multi-year low for a quarter. You did mention the media intensity increasing, but for the quarter specifically, would you, say that, share of voice has largely been maintained, and is the significant reduction only on account of, lower volume or lower rates as well?
Yeah, no, thank you so much, Harit, for your question. See, for us, our brands, along with the people, are the two most valuable assets. And hence, we continue to invest behind our brands to build long-term memory structures. We do what is right from a strategic point of view, that is essentially, over long-term, the sanctity of the business model. And the point you mentioned about A&P, of course, the number in the quarter, Harit, will always get determined by the media intensity which is there. Given a broad-based inflation which FMCG industry is facing, there has been basically overall amount of media investment in the industry has come down. And because of that, the overall absolute amount of levels of investment are determined basis what media heat is in the system. If I look at our own BMI percentage turnover, there are two factors. In fact, half of that is the volume stroke growth leverage that we have. Since our business has grown at 16%, everything else be equal, the media percentage, A&P percent turnover looks better. Half of that is basically the market heat, which is lower in a high inflationary atmosphere, and hence absolute amount of reduction on that count in terms of media investment. Now, suffice to say, our share of voice is ahead of our share of market. We maintain competitive levels of both spends from a salience and reach perspective, but at the same time, we do drive a very sharp media attribution to growth. So hence also our media efficiencies, the way we deploy our investments is very well measured. But we will not blink. Time and again, we have reiterated our share of voice will continue to remain ahead of our share of market.
Thank you very much, Ritesh, for this. My second question was on fabric wash. So, the growth rates over the last few quarters have been extremely strong. I just wanted to get a sense of, how much of this is being driven by actual category growth and how much of this is, by your market share gains. The reason I ask is, once, there is a normalization of the base where, you had some COVID-led impact as well, category growth should start to normalize to probably historical levels. So I just wanted to get a sense of, how much of this accelerated growth is category-led, how much of it is market share-led, in whichever way you can help with. Thanks.
Yeah. So on fabric wash, there are a few variables out here. First of all, one of the points I was mentioning about product superiority, the kind of work that we have done in that space has started seeing results across the board for us, and which is why in fabric wash, of course, there's a market growth, but we have grown ahead of the market and also have handsome market share gain in fabric wash. So our performance is ahead of the market where it is. This is also the outcome of building portfolio over years, over last several years. The way we have built our portfolio from mass to popular to premium to liquids. And that benefit is what you see also in our growth momentum as we speak. I was giving an example earlier of our liquids portfolio, which is both liquid detergent and fabric conditioner liquids. Put together today, that is more than 2,000 crore annualized business that we run today. Now, those are many more elements apart from pricing, which your point is right, which of course is also helping to drive growth. But at the same time, the product superiority, the strong portfolio, and a right amount of consumer price value equation has also made us grow volumes. And as I mentioned earlier, in this quarter, we also have driven very strong volumes in home care. So it's a pretty all-round performance as far as fabric wash is concerned.
Thank you so much for this, Ritesh, and wish the team a very happy Diwali. Thank you so much.
Thank you so much. Wish you too a happy Diwali.
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi everyone, and congrats on a good set of numbers. My first question is on the two digital brands that you've launched. Are these something completely new, or are they sort of taken from the global portfolio?
Hi, Percy. Wish you too a very happy Diwali. So, Percy, both these brands that you see, Acne Squad and Find Your Happy Place, these are mixes that we have crafted. Acne Squad is crafted completely locally for India. And it's a pretty, if you look at the skin overall as a category need state, acne comes as one of the top need state. And which is why we crafted this portfolio working with dermatologists. And we launched all the 4 different platforms within Acne Squad, which are the different life cycles of acne that impacts. So it's a mix which is crafted in India and launched in India. Find Your Happy Place has been launched in one part of the world by Unilever. And that's the second market in the world is India, where we do believe it has fabulous relevance, and hence we brought that brand and we launched that mix in India. Both of these, as I mentioned, as you picked up, are launched digitally. So they have been launched on our D2C website, and they also have been launched on PurePay, the Amazon and Flipkart equivalent.
Right. So just I wanted to know basically what is the thought process or decision-making framework for launching new brands in the D2C space versus trying to address sort of needs through existing brand variants, etc. And do you think under this framework, there would be more brand launches in the future as well?
Yeah, Percy, as you know that we already had launched 3 brands in the prior periods, be it Simple, be it Love Beauty and Planet, or for the matter Babyta, which are all our 3 direct-to-consumer brands. And we saw demand spaces that we could activate and then we could start playing. And which is why we then said in acne space, which is becoming a good important need space, we need a portfolio in that space. The way we worked, and one of the examples we had quoted earlier as part of our capability, we have our own agile innovation hub where we scrub all the trends which are emerging with consumers across the country. And then depending upon what relevant trends we pick up, our first decision is, does our existing portfolio cater to those trends? If yes, of course, our portfolio is activated and we serve those needs. And we have large brands across our portfolio in FMCG, it does the job. But if there are demand spaces which are developing and they are becoming relevant at this point in time, in which case then we choose then to deploy our portfolio in that demand space. Acne is a classic example of that demand space. Or for that matter, a bath indulgence is a fabulous demand space. The very fact these are niche, and which is why it makes sense to go digital rather than do an offline launch at this point in time. You have to build awareness before you can start talking offline. And which is why exactly the thought process and the business model out here has been that look at the trends which are relevant, where we think a portfolio launch will make business sense, then we launch those mixes. And a capability to launch digital just gives us that power of experimentation before we scale up in any other format or any other channel. So that's the business model which are behind it. Now, is this the first and the last of it? Answer, of course, is no. We have done 3 before, we've done 2 now. We'll keep looking at trends, and the moment we find a trend, a demand space which is substantial, and it makes relevant to invest with the product portfolio, we will innovate and we will launch product in that portfolio, in that space.
Right. My second question is on the market shares, where you mentioned that 75% of your portfolio is growing market shares. Could you throw some light on what are the parts, the 25% where you are not, which are those categories? And you mentioned this over the last 2-3 quarters. So is this 25% the same over the last few quarters, or is there a rotation there also that this quarter it has gained, but next quarter it falls into the losing bucket, etc.?
Yeah, so first of all, Percy, our narrative is very clear. Our market share performance and our competitive performance is very robust. More than 75% of our business is winning. And that was a narrative we had in the previous quarters as well, where more than 75% of our portfolio has been winning. And this win is pretty comprehensive. This win is across the geography in the country. This win is across channels, be it traditional channel of traditional trade channels, general trade, be it the modern channels of e-commerce to modern trade put together. This is growth of business performance in urban. This is in rural. And all this ultimately has also translated into corporate market share gain as well. So this is what we also do in our business. We keep looking at a different segmentation of our business, and in every segment how competitive our performance is. And which is why, as I mentioned, it's a pretty comprehensive performance, and when more than 75% of our business is gaining share.
And any clarity you can give on what are those categories which are not gaining market share?
So I will not get, Percy, into individual categories which are growing, which are not growing. As you mentioned earlier, at the end of the day, we deal in a market which is extremely competitive. There will be ups and downs in the portfolio. If in long term we keep maintaining the strength of business winning at more than 75%, it will translate into corporate market share gain. And that's the exact reason why in our mind we keep looking at our business winning of more than 75%, and we have delivered that quarter after quarter. And we have seen that exactly leading, also translating into corporate market share gain as well. Now, in a quarter, if we have few BPS up, few BPS down, of course, that portfolio in that quarter might be not winning, and it might be the reason why you're not at 100%. But then it's a matter of time, I'm saying, as we see some sense in certain categories, and then we, of course, lean in more in that space. So it's always a mix of that. But the fact is, when you have more than 75% portfolio which you're winning, it's a comprehensive business performance, and this is where we basically angle ourselves into.
Right, Ritesh. Thanks a lot. All the best.
Thanks, Percy. Thank you so much.
Happy Diwali.
Best wishes to you. Happy Diwali as well, my friend.
Thank you. The next question is from the line of Arnab Mitra from Goldman Sachs. Please go ahead.
Yeah, hi. Thanks for taking my question. My first question was actually also on the laundry business, where despite putting more pricing, the volume growth has actually accelerated. So last time when such high price increases were put maybe 10 years back in the category, there was definitely some pressure on down trading. Just wanted to check, are there any trends of that sort, and your acceleration in the face of increasing pricing, is it largely to do with market share gains accelerating in these last 2 quarters?
So there are a few elements out here. First of all, you're absolutely right. I think in the last 1 decade, the way HUL has transformed the portfolio of home care, and the point I was making earlier of liquid part of the portfolio, be it liquid detergent, be it liquid conditioner, which is now a more than 2,000 crore business. So A, portfolio development, B, product superiority. Those are the elements, and of course the strength of our brands that we have. Fabulous brands from Surf Excel to Wheel to Rin, and the strength of our brands have also allowed us, A, to take pricing, B, to maintain price value equation, and 3, to hold and keep growing our consumer franchise. So it's a pretty all-round performance the way the portfolio has panned out. Now, to your point on downgrading as to down trading, what we have seen in times of very high inflation, consumers seek more value. In certain portions and certain part of the portfolio, more value comes from price point packs. There might be low price point packs of 1 rupee sachet, or a 2 rupee per pack, or a 5 rupee Horlicks sachet. In certain parts of the portfolio, especially laundry, the large packs, as you know, offer better value. And hence consumers by default go to packs which offer them higher value, in these case larger packs in laundry. So we have seen a mix of that as well, and we have played our portfolio very well across price points and across the portfolio. The premium part of the portfolio, and I'm talking largely overall as Hindustan Unilever, has grown at twice the pace than the rest of the portfolio. So we have seen in laundry as well, as you know, we have premiumized our portfolio, and that overall behavior that we have seen, A, of consumer, and B, the strength of our brand and portfolio, we have seen that benefit in our growth as well, where the premium part of the business is growing at twice the pace. So be it premium brand like Surf Excel, laundry in case. So those, I would say, are 4 or 5, I would say, strong reasons why our performance is so robust, not only from a value growth perspective, but also from a volume growth perspective, and absolutely also from competitiveness perspective. As I mentioned, we have one of the best market share at this point in time in fabric wash.
Okay, thanks so much, Ritesh. And my last question is on Horlicks. So this launch of gummies, when the brand was with GSK, they had made multiple attempts to use the brand outside of MFD. Do you think from here on HUL would also look to do that, and this is a starting point, or we should not read too much into this launch of the new format?
Yeah, see, as we acquired another business of Horlicks, and let me talk brand, then let me talk format, and let me then get into demand spaces. From a brand perspective, we have spoken about, as we acquired the business, we activated Boost across the country. So now we have Boost present along with Horlicks across the nation this point in time. So that was the first job we did in terms of portfolio maximization from the Horlicks portfolio and from the GSK what we acquired, number 1. Number 2, we also then activated the Plus range. And we mentioned that this is where then we deployed our high science range, be it Diabetes Plus, be it Horlicks for Bones, be it for women, be it for lactating mothers. And that part of the portfolio also has seen good traction as we have activated. And then after having done the job with Horlicks and Boost, after having done the job with Plus, third area that now we have seeded is gummies. And as I mentioned, this is more of a seeding than a launch full-fledged. This is more in D2C. Of the 2 formats that we launched, both the Nutri Gummies and Diabetes Gummy, one of the 2 we launched earlier, as you know, Nutri Gummies, which we launched D2C. Then we've taken now that to also pure play. Then we launched after that the portfolio of gummies for diabetes. That we launched on our D2C website. And we will see consumer traction, how we get for these products and how we're able to develop these products. And that's the whole intention of launching and seeding this business as well, alongside the portfolio of the 2 brands and a fabulous portfolio that we activated in the Plus range. So this entire attempt of looking at what are different ways we're able to serve consumer needs in functional nutrition is what our attempt will always be. At the cornerstone of all of that is one singular insight, that India as a nation overall we do have micronutrient deficiencies. Our diet is very high on carbohydrates, and hence this becomes a fabulous need for us to use a functional nutrition portfolio and to play to that demand space where people might be eating enough calories but might not be having right micronutrients as part of their food palette. And this is where the portfolio makes sense, and we will keep looking for such opportunities within the portfolio.
Okay, thanks, Ritesh, and happy festive season to you.
Yeah, happy Diwali to you as well.
Thank you. The next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Hi, thanks for the opportunity. Hi, Sanjeev. Hi, Ritesh. I have a few small follow-ups, to comments that you made earlier. The first one was a check on, beauty and personal care premium segment doing well. Is there an element of festive pre-buying in the channel for premium skincare that could have helped the quarter? Is that salient material?
Hi, Latika. Is you're saying whether the premium has been impacted by any activity during the quarter? Is that the question?
Yeah. Has that been positively impacted from pre-festive buying?
Latika, premium has been growing consistently over this period. Yeah, and that is a very clear trend. And as you would recall, we are over-indexed on the premium segment. And premium segment, we are over-indexed, and it continues to do well. Even if you look at it from a lens of market, premium is growing faster than popular, popular is growing faster than mass. And this is a very clear trend, and it is in many ways intuitive because people who have more money are a bit more resistant to inflation than people at the bottom of the pyramid.
Okay. The second question that I had was on, price reductions for soaps. Just wanted to clarify, is it pure MRP cuts that you've undertaken, or is there a kind of a grammage increase also at low price packs that the company has deployed? And are there any reductions in the laundry portfolio also that you have considered?
Yeah, so 2-3 different, let me just probably come back a little more comprehensively. And as I was talking earlier, tea and skin cleansing are the two portfolios where we have seen commodity coming off. Earlier it was tea, and then the latest has been vegetable oil. And we have reacted, and the point I was making earlier, when prices went up, we took in small bites, we took price increases. And when we have seen a meaningful commodity correction, we have taken in large chunks price decreases as well, be it tea or be it skin cleansing. The inflation impact in home care has continued. And you have seen that crude has remained firm at 90 plus. And now with US dollar being strengthening, if I just look at the data point today and a year ago, it's a 12% impact on Indian rupee. And that impacts overall commodity costs because either the commodities are international markets or at least they are sold and bought at international port parity. So crude, the point I was making, though it is 90 plus firm, but if I add the impact of currency, it is almost $100 plus equivalent in Indian rupee. So we are seeing, and because of that, in September quarter, we did take price increases in sequential price increases in home care laundry portfolio. So it will all depend upon, and within laundry stroke home care, Latika, also we had called out soda ash has seen a meaningful amount of inflation, again coming from energy and overall demand supply of the commodity segment. So we have seen that, but we will keep doing that depending on which commodity basket impacts which category of ours. We will keep being very agile and nimble on this front. And if at all we do see commodities coming off, we will go with price decreases, as I mentioned, in big chunks. And where we do see commodity remaining firm as required to protect the business model, we will take price increases. If I look at latest September quarter, the point I was quoting earlier, with a 22% net material inflation and a 12% price, we have a pretty substantial 10% price versus cost gap. Now, I do believe that with crude oil remaining firm because of the, I mentioned to you, because of the currency, but with some cooling off happening to some extent in vegetable oil, there should be slight improvement in price versus cost gap in next quarter. But we'll have to see this quarter after quarter, month after month, and depend upon which commodity and which category gets impacted. But we will be very agile and nimble with our decision making and with the speed at which we're doing. And the kind of reflex muscles we have developed with our science of pricing, that is something which has been a pretty strong competitive edge for us during such difficult times of high inflation across the portfolio, or for that matter, commodity volatility that we have seen across the portfolio.
Sure. Yeah, Ritesh, I was just checking because, there were certain media articles which reported price reductions for laundry as well. And I was just trying to confirm that reductions are so far only in the soaps portfolio, and probably also checking there could be some grammage increases at price points, right? Not just MRP cuts. The other bit that I wanted to check was on increase in employee cost of nearly 20%, sequentially and YOY. Any specific reason here?
Yeah. So there are three different variables on the overall. The commodity costs have gone up by 20 BPS. We've seen in terms of percentage turnover. So there are three reasons out here. A, the overall inflation of wage inflation in the country, and which is why there's a salary inflation, which is there part of the mix. Number one. Number two, we also had a VPA true up as part of our first half performance, which is pretty robust, as you have seen with our results. So we have upped our provision for our variable pay as part of that, and that has also impacted the numbers in the quarter. And there is also a component of our overall cost, which is shares of Unilever, which employees get. And depending upon the movement of share price of Unilever and GBP vis-a-vis INR, which has seen in this quarter an uptick. So those are the three reasons put together. You've seen overall the employee cost being higher compared to where our top line growth has increased. Yeah, but this is always there's always some amount of variability you will see, Latika, in terms of employee costs. But if I look at overall, let me say a trailing 12 months or a 12-month view, we will always be efficient, where our overhead cost, we keep getting leverage. Why? A, because we have a very frugal mindset goes across all lines of overheads, number one. And number two, growth leverage that we have because of our stellar growth performance that we have. So put together, overall cost will always see leverage, but there will be some volatility like this on quarter on quarter.
Sure. Thank you so much, Ritesh and Sanjeev.
Latika.
Thank you. I now hand it over to Mr. Ravi Shankar for further proceedings.
Thanks, Tanvi. We have one question on the web from Richard Liu. Richard asks whether we can give some perspective on how exit trend has been as far as growth is concerned, especially from a rural perspective, given that August and September base months last year would have had the slower rural growth built in. Is the market number starting to look better relative to other months, at least on headline basis? And how would you read this data?
Yeah. So, hi, Richard. Richard, if I break up the September quarter market growth, FMCG market growth, into two parts, July and August put together as one bucket and September as another bucket. Definitely, month September has been better than July and August put together. The factor which has come out is essential demand generation, which we have seen more in modern trade channel. And number one. Number two, there's also that this time the phasing of season, festival season, is a little different than last year, where Diwali and Dussehra both are in the same time, and hence a couple of weeks ahead of what it was festival season last year. So in my mind, there is some impact of that as well in September month. But clearly, September month has been better than July and August put together. And overall, which is also the reason why, as you would see, that the market, overall FMCG market in latest 3 months, which is September quarter, is ahead of the MAT. MAT is more at mid-single digit, and September quarter is more at 6.6 to 7%. So we have seen September month a little better. How this pans out in next 3 months' time, in my mind, the single biggest variable will be commodity inflation and what happens to currency and hence impact of currency on commodities. That will ultimately determine the consumption levels in rural and overall consumption levels in FMCG. And that, in my mind, will be the single biggest determinant what we should expect going forward. I spoke earlier about rural in terms of macro. There are elements of rural macro which are in favor, and hopefully they pan out as intention has been and as government's intervention has been. And that should help both farm and non-farm income. And if that happens, it should augur well for rural economy. And hence, in turn, if commodities, we see a broad-based impact, and if at all the rural economy does pan out, this is government intervention, we should see a better outlook. But as I mentioned earlier, we would want to see for a few more months before we start signaling a trajectory change this point in time. And we've been measured with our commentary, and the latest quarter, 3-month number of September quarter, has only borne out of what we've been giving our narrative on outlook even in the prior quarters. But thanks so much for your question.
Thank you, Ritesh. With that, we'll draw the Q&A session to an end. I know we haven't been able to take all the questions. If there is anything still unanswered, please feel free to reach out to any of us in the IR team. Before we end, let me also remind that the playback of this event will be available on our website in a short while from now. Once again, our greetings to you and your families for the festive season. Thank you and best wishes.
Thank you all.
Thank you. On behalf of Hindustan Unilever Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.